In the last video, we mentioned how the wealthy see the world differently. Today, let's dive deep into how great investors see the market differently. Here you can see markets are an auction. In the middle, you've got the fair price area. Short-term buyers and sellers trade with each other here. If price breaks out above the fair price area, a momentum trader sees this as confirmation of strength, and most of them would buy high to sell higher. At the same time frame, above the fair value zone, is the advantageous area for long-term investors, where value investors sees that same area as overvalued relative to fair price. This is what I call one person's momentum is another person's mean reversion. What looks like momentum to one trader looks like mean reversion opportunity to another investor, and vice versa if the value of the asset goes down, meaning the same price level can be bullish for one trader and bearish for another. Every price is just an intersection of beliefs. There's no absolute bullish or bearish price level. Markets are auctions. They move up until the last buyer buys and down until the last seller sells. Price discovery is literally just the process of testing extremes until supply or demand runs out. So the question everyone wants to know is that how do we approach the market in a way that increases our probability to profit? One important message here is that we all have to realize your true edge isn't in predicting every move. It's in knowing which game you're playing. There are mainly three types of players. In the short run, momentum takes over when volume surges, volatility expands, momentum dominate the trends extend far past fair value. In the medium run, mean reversion takes over, volatility compresses. Swing traders sees the same move as a dip inside a bigger range. Prices snap back to balance. In the long run, value investors sees both as noise and decide prices align with fundamentals. Long-term capital begins rebalancing. Value takes over when exhaustion sets in. Remember, the winner will be the one whose time frame dominates the market at that moment, meaning the market is always a battlefield of time frames. Dominance goes to whichever group has enough capital and conviction to bend price action to their logic at that specific moment. The order flow from that group of players sets the direction of price. Now, let's take this framework and apply it to what we're seeing with Bitcoin this year. A lot of people ask, if institutions are buying, why hasn't BTC broken higher? Here's why. Institutions indeed are piling in on the buy side. But look at this. These zones at 85K, 96K, and 104K. Every time BTC pushes into these levels, long-term holders who've been sitting on massive profits for years start selling. So even though institutions are buying, the rallies are capped by old supply. This is time frame conflict in action. The market doesn't care if you're right in theory, and there's no absolute right or wrong in markets. There's only one time frame that dominates the auction at one specific moment. Your edge is knowing whether you are playing momentum, mean reversion, or value, and aligning yourself with dominance instead of being crushed by it. In our private community, we consistently explore signals like price behaviors, volatility expansion, and liquidity flows, so we are positioned close to the dominance of market movements. Practical implication for all of us before we go into any trade is that don't confuse our time frames. Define concretely whether you're trading short-term auctions, medium-term rebalancing, or long-term value. Your edge comes from staying consistent to your game, not getting dragged into someone else's. You will find your probability to win increase tremendously.